The Indian government dropped a massive toll on precious metals. The math you relied on yesterday to buy, sell, or transport gold is now obsolete. The 6% tax became a 15% structure, 10% duty, and 5% cess. Why? $71.98 billion of gold flooded India as prices neared $100,000 per kilo. With the trade deficit hitting $333.2 billion, taxes were raised to protect foreign reserves. This macro-level panic impacts three groups: domestic retail buyers, equity investors holding jewelry stocks, and non-resident Indians carrying gold. You have to calculate this 15% premium into your strategy right now. Ignoring it means overpaying by thousands of rupees at the local jeweler, or worse, facing devastating financial penalties at airport customs. Let's look at the local retail market first. Here at traditional storefronts, the domestic buyer is taking the immediate hit. Jewelers pass the entire 15% import duty directly to the consumer.
Because of this, in major cities like Delhi and Mumbai, the baseline price for 24-karat gold easily crosses 154,000 rupees. When you pay that baked-in tax, you dig a deep hole on day one. It pushes the break-even point on a physical gold investment years into the future. This pricing reality pushes the risk onto equity investors holding shares in major retailers like Titan, Kalyan Jewelers, or Senco Gold. This quadrant chart plots physical gold against jewelry stocks, measuring the friction and tax burden against long-term return potential. For the stocks, the immediate threat is demand destruction. Consumers might simply refuse to pay the 15% premium and delay major purchases. Investors traditionally use these stocks to get gold exposure without the physical storage risks, but now you have to weigh whether these retailers can maintain their margins through a severe drop in retail foot traffic. Physical metal guarantees you actually own the asset. But as you can see, its position on the tax burden axis is now maxed out to the extreme right. For domestic residents, buying physical gold is currently a highly inefficient way to store wealth. The numbers favor pivoting toward paper assets or carefully reevaluating your exposure to retail jewelry stocks. For non-resident Indians, especially expats working in the UAE, the traditional play has always been the Dubai to India gold arbitrage. The government does offer a loophole, but the first requirement is non-negotiable. An NRI must live abroad for more than 6 continuous months to qualify for any customs allowance. This flowchart maps out the exact legal allowances. If you meet the 6-month residency rule, male passengers are legally capped at bringing in just 20 grams of duty-free gold, with a maximum value of 50,000 rupees. Female passengers get exactly double that allowance, 40 grams, capped at a maximum value of 100,000 rupees. Here is the major catch. This duty-free allowance applies exclusively to finished personal jewelry. It does not apply to raw materials. While this lets you dodge the 15% Indian import tax, jewelers abroad charge steep making fees for finished pieces. Those fees eat directly into whatever price advantage you gained in Dubai. Between the strict gram limits and the unavoidable making charges, this allowance is only useful for personal gifting. It fails entirely if you are trying to execute a serious wealth transfer strategy. The most financially dangerous mistake an NRI can make is trying to scale up returns by packing pure gold bars and coins instead of jewelry. The duty-free allowance explicitly excludes investment-grade metal. Gold bars are out, gold coins are out, and gold biscuits don't qualify, period. Look back at the flowchart. If you bring in bars or coins, you hit a dead end. You are required to declare them and pay the mandatory 15% duty, no matter the weight. That zeroes out the discount you got abroad. Some travelers think they can just walk this investment gold past the red channel without declaring it to customs officers. That is a massive legal risk. Under Sections 111 and 112 of the Customs Act, getting caught triggers dual penalties. The authorities will confiscate the total asset, and they will hit you with independent, heavy monetary fines on top of that. Customs officers track your exact travel history through passport stamps and digital databases. You cannot fake the 6-month residency requirement, and you cannot slip bulk metal through the scanners unnoticed. Trying to bypass the 15% wall with physical investment gold turns what looks like a clever tax avoidance trick into an unrecoverable loss of capital. So how do you defend your capital against this 15% duty wall? Let's finalize the strategy for all 3 scenarios. This scorecard matrix reveals optimal paths. Domestic investors must pivot to sovereign gold bonds to avoid physical tax premiums. Casual NRIs should respect weight limits and carry original invoices to prevent customs friction. For NRI optimizers importing bulk bars, cross-border arbitrage is mathematically dead. Once you pay the legal 15% duty on gold bars, your final landed cost essentially matches the domestic price in India. There is zero financial incentive left to take on the transport risk. You have to abandon the outdated advice from relatives about grabbing cheap Dubai gold. The regulatory math has permanently shifted. The Indian government has successfully walled off physical gold. Moving forward, reliable returns belong entirely to those who adapt to paper equivalents or respect the unforgiving math at the border.